Hello, ladies and gentlemen. I'm Sarah Lowther, and a warm welcome to today's Master Investor webinar, which is designed to give you insights into the era of innovation and investment opportunities in technology and AI. Over the next hour and 15 minutes or so, you're going to hear from an expert in the field and two companies at the cutting edge of tech and AI innovation. Now, this is an interactive webinar, so if you have any questions you'd like to ask, please put them in the chat, the Q&A feature, and we'll endeavour to get through as many as possible. Okay, first up, he started his career in the telecommunications software industry, roll on a couple of decades, and after experience at the tech coalface and the city, he is now head of Edison's technology, media and telecoms team. I'm delighted to welcome Dan Risdale. Dan, over to you. Thank you very much indeed for joining us.
Thank you very much, Sarah. And good to meet you all. I'll briefly introduce myself. I head up the technology team at Edison. We're an international investment research and investor relations business. We cover companies across the globe, not just in the UK, across the US, Europe, and Asia, and we look at things on a very domain-focused basis. Perfect. Maybe if we move on to the next one. So this is me. Just a brief history of ourselves and artificial intelligence. We've been looking at the domain for a long time. We actually published a report back in 2021 on a thematic report on artificial intelligence, where we felt the need to start the report by saying artificial intelligence is real, and how things have changed since then. And one of the questions we often get about artificial intelligence is this overhyped, or is it in fact underestimated? And I think one of the things to realize is that technology cycles and hype cycles always go hand in hand. You can't extricate one from the other. But it is certainly the fastest and possibly the most significant technology transition we've witnessed yet. And as we can see from the chart below, the structural changes in technology and the increasing importance in technology has been the key driver of US stock market growth and therefore global stock market growth. And it's a trend that we need to embrace to generate positive returns, to generate good returns. And unfortunately, it's also been a trend that the UK hasn't embraced as well as some other markets. Can we move on to the next slide, please? So the first thing I would say is embrace the trend. The changes that are going to come around as a result of artificial intelligence are going to be profound. They're not just going to impact the technology sector. They're going to impact all sectors. And if you ignore it, you're at risk of making poor investment decisions. And it's a tricky subject because a lot of people put it in the too difficult to analyze bucket. But there's a good quote from Mark Cuban there. Artificial intelligence, deep learning, machine learning, whatever you're doing, if you don't understand it, learn it, because otherwise you're going to be a dinosaur within 3 years. And you can see some other quotes here from prominent investors, and including some of the key UK technology investors on the right-hand side of that chart. Might be worth highlighting the quote on the bottom left: artificial intelligence is not just a technological advancement, it's the dawn of a new human era and human potential. That one's actually generated by artificial intelligence. So I didn't think I could have an AI presentation without an AI hallucination. So that quote at the bottom left is completely made up by an AI. And that's just one of the things we need to be wary of with the whole evolution and the surfacing of this thematic. If we could move to the next slide, please. One of the other points that I'd like to emphasize is that this is a period of disruptive innovation, and these come around every so often. On stock markets, the evolution of the automobile was one of the first. Um, and at times of disruptive innovation, we see accelerated value creation and accelerated value destruction. And you can see that demonstrated quite clearly on this chart. This is the chart of Nvidia versus Intel. So Intel up until 2023, I believe, maybe it's 2021, but up until recently, Intel was the most valuable semiconductor stock in the world. In 2019, it was valued at $268 billion. And what we've seen as the whole emphasis of computing moves towards parallel computing, it moves towards AI, it moves towards the cloud, and these are transitions that Intel fundamentally didn't position itself well for. We've seen a huge deviation, an enormous deviation in the valuations between Nvidia and Intel, and we will see this trend repeated for people who are well placed within the new artificial intelligence environment and those who are slow to react. So I think one of the key messages for investors is, just be wary of this structural trend, be wary of who's at risk, and look at who's got the potential as well. Could we move on to the next slide, please? If you look at the initial phase of value creation, and this is the AI delivery stack, if you like, infrastructure and hardware has really dominated this first wave of value creation. So we've seen the huge rises in values of Nvidia, and this whole new compute environment is really driving the semiconductor market and the whole infrastructure market that supports that. So it's not just growth in processors. You've got growth in computing, in connectivity, in power supply. A lot of innovation going into those areas, and you're seeing a lot of these companies are exposed to that trend. People like Broadcom, ARM, and so on perform well, and their share prices react. And at the next level, you've got the compute providers. So that's people like Microsoft Azure, Amazon, and Google Cloud. We also cover a company called Northern Data, which is Europe's largest NVIDIA high-performance computing center. And those companies have done very well, and they're obvious beneficiaries. As you move up the stack, however, the clear beneficiaries get less obvious. And this is in part why we have seen all of the value concentration, the value creation in technology and hardware. So on the right-hand side here, we've got the actual composition of the Polar Capital Technology Trust. This is a UK trust that's completely realigned its portfolio to focus around the AI thematic. And actually their portfolio is 53% hardware and equipment, and the balance of software and others is 29%. They're now looking to pivot that and looking for ideas in terms of software companies, AI users, and AI beneficiaries, but the value has concentrated lower down the stack. Can we move on to the next slide, please? So what are the opportunities in the UK? I'd like to show a slide of the relative performance of the UK versus other indices. So if we could move on to the next slide. US technology has delivered 150% return since 2020. The return from the UK market is 12%. And as we all know, the key driver of indices are your best and your strongest companies, those that are exposed to the strongest structural trends. And one of the things we've seen in the UK is that we just haven't held on to our key structural assets. We've seen companies like ARM and Darktrace, IQGO be acquired by private equity or strategic acquirers and so on. It's worth noticing. It might be worth noting that it's a completely hypothetical argument, but if the UK had kept hold of ARM and it had performed as it has, which is a big question mark, then our technology sector would have outperformed even the US, because at its current market valuation, ARM is worth more than the whole of the UK tech sector combined. And that's also a factor in why Europe has outperformed the UK, because they've held on to assets like ASML and so on. So, one key message from here is let's nurture, let's keep our key structural assets and enjoy the value that those businesses will create. The other point that I would like to make is the UK is good at this. The UK is good at artificial intelligence. Generally, we rank around number 3 in the AI rankings, and this is a chart from Global Data, listed UK company, which tracks the market. And they've got a balanced scorecard, and they rate the UK number 3, a distant third behind the US and then China, but number 3 nonetheless. So we're good at this. We've got a lot of expertise. We've got a lot of young companies, and it's really something that we need our capital markets to support, and our capital markets should be enjoying the benefits of this. So how can UK investors benefit from all of this expertise? How can we actually benefit from this trend? And there's 2 key thematics I'd like to focus on. If we could move to the next slide. The first opportunity, and this is how we can get exposure to our early stage AI companies. This is we've got this great body of expertise in AI, and there are some fund mechanisms whereby we can get good exposure to this, and highlight 3 here. All of them under coverage by Edison, by the way. The private equity side, HG Capital Trust invests and supports in B2B software companies. Its total portfolio has a value of over $140 billion. That would make it Europe's second largest software company. And it's actually got a team of over 20 in-house AI experts, and they've developed their own AI tool, which is available to all of its portfolio companies to support their progress. Molten Ventures on the VC side. It's a European VC. It's previously owned Darktrace and Graphcore, which was recently acquired by SoftBank, leading an AI chip company, and it also has significant AI exposure and domain expertise. And then finally, IP Group. It's a deep tech IP commercialization, a little bit less focused on AI, but a lot of investments in the deep tech areas that could benefit from its uptake. And it's also got one very interesting asset in FeatureSpace, which is an AI-related sort of cybersecurity business, which grew 50% in 2003 and is getting to an interesting size and performing nicely. So that's one. The second way of looking at it is to go vertical. AI is a horizontal technology, but there are focused small and mid-cap companies who will be key and who are needed by the big companies to drive adoption into vertical markets. The major players lack the bandwidth and the domain expertise in individual vertical markets, and startups. There are a lot of AI startups, but they also lack the data and they lack the customer base. And there is a big role for small and medium-sized businesses. And they can very much benefit from bringing the benefits to AI and enjoying the upside for bringing AI into vertical markets. Looking at the right side, what are some of the key success factors there in terms of vertical artificial intelligence? Firstly, you have to have an established customer base and domain expertise in one specific area. Secondly, you need to have data. You need to have data, and you need to have the ability to use that data. And one thing I would say is that companies who have been using artificial intelligence for a long time, things like machine learning, natural language processing, generally have their data in a better order and probably well placed to use generative AI and more emerging forms of artificial intelligence. Tier 1 technology relationships are also very important, and we can see people like Microsoft and Amazon, Google backing key key partners in vertical markets to help drive adoption of their platform. And then thirdly, AI is happening in the cloud, and having a good modern cloud platform is the key driver there. So just to round off, looking at some names that fit into that thematic. I won't go into all of these, but all of these businesses have good domain expertise in a specific area. They've got cloud platforms, and often they've got relationships with key tier one players. As I said, I think we're running out of time. I won't run into each one of these, but when you're looking at UK software businesses, look at these key attributes. There are many other names in this, that fulfill these categories, and I think many of our UK companies will do well. And the other thing to say is that the UK market and the UK technology market is inexpensive. There are great value ideas lurking in UK tech, and it's down to us to unsurface those.
Thank you very much, Dan. Great ambassador for UK Tech PLC. I've got time for one question, and I know it's still early days in the development of the enterprise AI ecosystem, making it difficult to pick a lot of winners, although you have picked a few. And Sophie, if you can put those names back on, if you can go back to penultimate slide, which is very useful. I'm just wondering how success will be determined. What are the factors? Technology, agility, access to capital?
All of those, and access to capital is a very important one. That's a challenge for UK businesses right now. I think, as I said before, a modern cloud platform, the ability to process this data and use artificial intelligence, is a key skill set right now. You obviously also need the data. If you don't have the data, it's very hard to actually start applying it and generating and learning. And that's one of the areas that small cap companies, startups, often don't have. It's one of the benefits of the small and mid cap space, in my view, is that we have this established market and we have these relationships. One thing I would say from an investor standpoint is that let's not throttle the growth of our technology companies. We're going through a technology transition. People will have to invest in order to adapt. They will have to invest in order to take full benefit of this transition. And sometimes we get a little bit too focused on margin and earnings or dividends, whereas companies have to go through investment cycles to achieve the next level of growth. It's up to companies to communicate why they're doing it and what the opportunity is. But if we're always selling our companies to private equity and demanding more margin and demanding more dividend consistently, then we will throttle the growth of our technology sector. Obviously, we want margin, we want cash generation in the long term, but companies have to go through investment phases, and we should support our companies when they need to do that.
Dan, many thanks. We have run out of time, but Dan, I'll just ask you if you can type a response to a question that's appeared in the Q&A section there. David asks, where is the real value in AI as a late entrant? So if you can respond to that, that would be great. While I go on to the next section of our webinar today. So to our next speaker now, and he understands the investor mindset as he's a value investor himself. He's also been chief executive for several companies in the fintech, agri-food and audiovisual sector. Today, he is chairman of Substrate AI and chief executive of its largest subsidiary, Subgen AI. Now, of course, there's been well, not of course, but there has been a rapid growth of revenues since inception in 2021, some 1,600%. I'm delighted to welcome Lorenzo Ceratosa. Welcome, Lorenzo.
Thank you very much. Thank you very much for being here in this webinar, listening to me. Thank you, Dan, for your great introduction to the AI field. Maybe you can go to the next slide, or yes. What is Substrate? We are going to present Substrate AI. Substrate AI is our Spanish listed company, also listed in the Aquis London. It's a small cap, and it's great if you want to be exposed as an investor to the AI field in a big picture, and not only in one sector or in one niche. And why I'm saying that? Because based in our generative AI technology from Subgen, that is our main subsidiary, that is based in London, is a London company, okay? From Substrate, we are building, we are using this technology to build different businesses around different fields in legal tech, agri-tech, health, finance, R&D. So building what we are trying to make them champions in their own fields, applying artificial intelligence and creating software in these fields. Dan has said something very important, that is that you have to have data to create good AI systems, and that's why what we do in Substrate. We can go to the next slide. What we do is we buy companies, okay, that are already in the field for sometimes very long time. In the health sector, it has more than 6 or 7 years working on this selling hardware. So they have a lot of clients, they have the data, they have the knowledge, they know the problems, they know everything that you have to know, and they have the data that you have to be able to apply artificial intelligence to this field. In this case, health sector, we will see it later, is the field of image diagnostic. So this is what we do. We buy a company that we call analogic company, maybe, that has of course a price of analogic enterprise, but has the expertise, the customer, also the cash, because most of them are cash generators, so they have EBITDA, positive EBITDA, okay? And when they don't have is technology, how to use, or the knowledge to use the data, and of course they don't have AI technology. So we buy these companies, we transform these companies, multiplying their value and multiplying the possibilities of growth in the fields. There is a big example that I love it, is Roper Technology, and what these people did in the United States in the field of technology, taking a pump company, very analogic company, and creating one of the most successful software companies in the 20s. We can go to the next one, please. So I was talking about one example. This is the second one that you see here. For this, a diagnostic imaging hardware, a company that we would develop a diagnostic software with AI. And we also brought another company, DXMAC. We consolidated there. And we have what is today 4D is a hardware and software company with AI in the middle, okay? And all related to the image diagnostic, giving tools to the animal veterinary vet field and also to the human fields, giving new tools for better diagnostic of illness, okay, using AI, faster, better, and cheaper, you know. So this is what we did with 4D. And also this is another example in the human resources field. Okay, we bought a company of human resources, IT Solutions, and we blended with a software that we developed. It's called Fleavy AI, that is helping companies to understand the workers, okay? As of today, we have workers that are not very happy in their jobs, and companies that are not able to find the talent that they are looking for to fulfill the goals of the company. So we need something to match all of this, to help to understand each other, okay, and creating better companies that are happier with the workforce and workers that are happier in their job. So this is what we do with Flibi AI. And so this is an example of our strategy doing this. We can go forward. So from 2024, we have bought a lot of companies. This is only a chart of these different acquisitions that we have done. We can move forward to be able to reach this. I was talking with two examples in the health sector, also in the human resources sector, but we are working in the agri-tech sector, iTech of Subgen, as I told you, the UK-based technology company. Okay, also we are working in the EdTech technology for education, and in the fintech and in energy. In these fields, in the fields that we can find companies that we buy, companies that are providing us the data, the knowledge, and also the problem, because sometimes startups, they say, we have a great idea, so let's start developing this because it's going to be a tool that everyone is going to use. We don't want to do that. We want to know which is the real problem of the clients, which is your real problem. So I'm going to try to solve this real problem. You know, detecting real problems is very important to have a successful software development. Okay. So this is the portfolio of Substrate. As of today, we can move forward. And this is the evolution of growing the company. As Sarah has said, the growth has been huge. Substrate is a fast-growing small cap, working in Europe, USA, and Latam. This year, we will reach 20 million of revenue, 4 million of EBITDA. Positive EBITDA is the first year we have positive EBITDA in the company. This is very important because it's going to help us in something also that Sarah and Dan were talking about, and is financing of the growth of an AI company. It's a key point because there is a lot of course, if you want to fuel a big fast growth, you need financing. Having positive EBITDA is very important to reinvest this EBITDA and to attract new investors to the project. Okay, so fast growth, small cap, working in Europe, USA, and Latin America as a big markets in which we are reaching these numbers. We can go ahead. So this is our work in numbers. So our assets, we have all these companies. We selected six of these companies in which we have made the most big investments. So the value of our assets is 45 million today in our books. And those are the percentage of the company that we own, 80% in the case of Subgen, or 100%, 70%. We never own less than 70% in a company that we want to transform and convert in an AI-driven company. Go ahead. So, and no, one before, sorry. Yeah. So here you have a comparison of the book value of the company, let's say Subgen, 26 million, or the valuation of the analyst, the last valuation of our analyst. So 29 in the case of Subgen or Flibi, from 6 points of investment, 20 million of valuation. 4D we were talking about, for 6 million of investment, 20 million of valuation. Of the other one, 2 million of investment, 8 million valuation. And so the analyst valuation as of today is 88 million with an investment of 45. So it's more or less doubling the value with the work in a very, very short space of time, only 2 years working on that, on some of these companies. Yeah, go ahead. This is a case of Subgen 2021. We acquired the technology developed for our American developer, R&D developer, Brentworth, for 50 million. So we developed new features, 1.5. So we acquire Another company, 70% of BNI, more than 100 developers, customers, businesses. So very important for building an AI company. So we are here another 25%, develop new features in the company. So for the end, that what we have today, okay? A company that is making around in 200 million valuation in United States. So go ahead. Well, I was talking about our expectations in 2034, 20 million incomes, 4 million positive EBITDA, growth of 42% from last year. Of course, net positive benefits or incomes. Go ahead. And this is our strategy of 2028. So continue with the growing of the company, investing in infrastructure, one key point that everyone knows, and also Dan was saying that is a key point today, and is where the most of investment is going, infrastructure, subsidiaries, new subsidiaries, or joining force with the subsidiaries that we have in the field, or opening new sectors in which we want to work, and new ventures, of course, to maintain this growth to 2028. And go ahead. Thank you very much for your time listening to me, and open to any questions that anyone has.
Many thanks, Lorenzo. Right, put your pen down. You're clicking it. It's hypnotizing.
Oh, I'm sorry. I'm sorry for that.
I forgive you. I forgive you. Right. So we've talked about capital injections to accelerate growths of companies involved in the AI ecosystem. Now, I've read that your expected funding requirements between this year and 2028 anticipated to be 180 million euros. And how do you intend to raise those funds, and from what sources?
Well, most of the we have brief projects on infrastructure, okay, with American funds here in Europe, because American funds are investing a lot in building data centers and building infrastructure for artificial intelligence in the European Union because of the regulation, and also UK, all Europe, you know. So we are working with them, and very likely we will join them, okay, to build this infrastructure. So they will be providing some of these funds. Let's say we are, in this case, talking about almost 100 of this investment, okay? The other investment, you have IPOs or some debt or capital increase, okay? We are talking about 50 in this case, 150. So these 50 IPOs of the subsidiaries, okay? Because all of these subsidiaries that I was talking before, they will make their IPO and they will have their own growth, okay, in the future when they reach the size needed. So some of them will come for the IPOs of the subsidiaries, and some of them with some debt or were to the company, okay, to start new buy-ins and new ventures.
It's just that one way of unlocking shareholder value would be achieved by exits. Now, you've only really been going since 2021, but would you consider exiting from any of your portfolio to generate cash?
We are working in three exits, not for selling the whole company, keeping the majority of the shares, yes, but making an exit to get new investments, new possibility for new investments, okay, to keep growing in the building, sector champions in AI use.
So I love the way that you say sector champions, but I'm wondering if the main obstacle is from the regulators. So is your offering a Serenity Star? Is it compliant? Do the regulators get it? Or are you really having to educate regulators to understand what it is you do?
any sector that appears that has appeared in the past, okay, finally have a regulation. So you have to count that you will have a regulation, because it has happened. If you see the story of the economy, okay, so in the petrol sector, we started doing whatever. So today you have a big regulation to do this, and it's happening in all the sectors. So AI will have a regulation everywhere. And this is normal, you know. So you have to work on that. So as you said, in Subgen, in our SaaS software that everyone can use, I encourage the people to go to Serenity Star, register, and use it for free, and start building their own AI project for their companies, wherever. So everyone can do it. In this SaaS, Serenity Star, we place very, very focused in compliance, in regulations, in the use, ethical use of the AI, if you want to say it like this, and also in security, okay? That data security is a key point for artificial intelligence use in the companies, okay? So a lot of companies are totally worried about the security of the data that they are using, and how this data is going to be, you know, out of the company or whatever, using artificial intelligence. So we focus in these two key points, okay, to be able to give the tool to the companies to scale artificial intelligence, you know, in their operations.
Okay, well, without giving too many plugs to Serenity Star, because I'm not on commission, but I do want to know, how easy is it for companies to embed Serenity Star as it is a software as a service platform? How energy hungry is it?
This is very easy. It's very easy. You know, Serenity Star is helping the companies to scale artificial intelligence, and is trying to solve all the pains that companies has. One of the pains is there is not enough people who knows how to use artificial intelligence. So we have developed low code, no code possibilities to apply artificial intelligence. So most of the people can do it. And also we have created a copilot called Serena, okay, that is helping you through the platform to do whatever you need to do to create your own systems, let's say for your website or whatever, okay? So it is very easy to use it, and with your own IT people, okay, people that doesn't know anything about how to use artificial intelligence, on how to apply it, with your own 80 people, you can start using 2, 3, 4, systems for your, let's say, your website, your clients, relationships, or whatever you want to use it, you know.
Okay, understood. Now, Vinay asks, what's the minimum ticket size to invest in Substrate AI ventures? Thank you. I don't know whether he means
Substrate is a listed company, so you can buy any stock into the market in the Aquis or on the Spanish BIMI Growth, on the OTC. We are listed in these three markets, and stocks are very cheap today, so you can buy it very, very happy.
Okay, maybe not cheap, fair value. Value. And finally, somebody's asked for your email. Again, I think it's a bit too much for Sophie to bring up that slide, but if you can articulate your email for us very slowly so that we can write that.
You can write to info substrate.ai.
Okay, I think that might be on your website as well.
Yeah, for sure. Through the website, you can connect with us, substrate.ai. So you have all the information there to connect with us.
Excellent. Thank you very much indeed. And hopefully next time we see you, we'll be talking about, because I understand there's a reorganization coming up, which is very exciting for you.
Thank you. Thank you. Thank you very much. Yes, we will talking about it.
Excellent. Thank you very much, Lorenzo. Really appreciate it. So, and thank you very much for your questions as well. So to our final presentation, and it's about global internet solutions company Team Internet. Now, it's been recognized as one of the top 50 tech industry companies in the FT 1000 list, and has also been included in the FTSE AIM UK 50 and AIM 100 indices. It's been all over the place. The market cap is £324 million. Joining us is Group Chief Financial Officer Billy Green. Billy, very good to see you and hear you.
Yes, nice to see you, Sarah. Obviously, I know that there are at least a handful of Team Internet's current investors who joined this call today. So welcome and glad to reconnect with you all, and indeed to connect with everybody who's on the call today. Just to give you a very brief introduction as to how I'm going to run Team Internet's presentation. My aim is just to pull out from our regular investor presentation a couple of the slides that are very super relevant to the topics of artificial intelligence and also to data. Dan, helpfully in his presentation earlier, played up the importance of data and having a broad data set, a powerful data set when you're an artificial intelligence inspired company, as we are. So my aim is just we'll skip very quickly through most of the deck, but there are at least two slides where the importance of artificial intelligence to Team Internet as a business are absolutely critical. So if we could move on to the fourth slide, because the second slide's just a disclaimer. If we go into this fourth slide, this is the first slide I want to dwell on for at least a few minutes. So Team Internet as a business, some of you will know, some of you may not know, and for those of you who are interested in a broader overview and for me to spend more time talking in more detail about all parts of the Team Internet group, we typically have at least a quarterly investor meet company presentation in respect of our quarterly earnings. And there are obviously other retail events at which we talk more broadly about the company. But specifically to artificial intelligence and to data today, the company operates in two segments. Roughly 75% of the business is represented by the online marketing, what we refer to as our online marketing segment. So that is an advertising business. Its revenue primarily comes from the advertising ecosystem. So it's a media company, an online media company. The remaining 25% of the group on the right-hand side of the screen, you'll see we refer to as online presence. That is effectively a domain name procurement and distribution business. So it's in the domain name industry, and it primarily links up with the registrants of domain names and procures and then distributes those either to domain name resellers or to the retail market, i.e. ultimately underlying customers who want to make use of a domain name. So we'll spend less time focused on online presence because as of today, it is slightly less reliant on, or our model is slightly less reliant on artificial intelligence. But there is relevance and crossover with the online presence segment to artificial intelligence. So we'll touch on it a little, but I want to spend most of the time talking about the online marketing business. And you'll see on the left-hand side in that dark blue box, you'll see that in our online marketing segment, we match audiences across walled gardens by harnessing artificial intelligence and first-party data. But to expand on exactly what that means in practice, matching audiences, that's effectively what most forms of advertising are there to do. So that's not something that's new, whether it be broadcast advertising, out-of-home advertising, online advertising. We seek to match an audience. So you may hear me refer to that audience as users or eyeballs or consumers. Those audiences, we need to match them up with the advert or adverts which hopefully most closely reflect their intent as a consumer. So that's the aim of the game in terms of all of our marketing models. Specifically, the way that artificial intelligence is relevant to us, and without which we have quite a different business model, is that we utilize, and we'll come on to the individual names of them later, but we utilize a number of platforms, and those platforms, which you can basically think of them as machines, because whilst there are obviously many other companies that have been mentioned before on this call that specifically either have a reference to AI in their name, or they exist in order to facilitate investment in AI companies. AI, artificial intelligence, is basically a resource for us. So we have teams of data scientists, people in Munich, Krakow, Belgrade, many other locations, and the machines, the platforms, are effectively another resource. So they are a resource that take the place of work that would otherwise have to be done by hundreds or thousands of individuals. And you could almost say, actually, that the work that our platforms does could never be done by even an army of individuals. The reason being, the nature of our platforms is that our platforms determine how much to bid via an auction system for the acquisition of traffic, so the acquisition of an audience. So we bid to place an advert to acquire traffic to bring them onto our platform. The platform then determines how to steer and filter the path of that traffic, that user, and then it determines which advert or which output where in the demand chain to deliver the user to. So as you'll realize, given that our platform calculates how much to bid for the advertising in the first place to acquire the user, it absolutely has to be driven by an algorithmic system based on the probabilities of where you are going to deliver that user to. So a human being, or even a team of human beings, would scarcely credibly be capable to do what our platform does instantaneously, which is to in real time manage the cost per click we have to pay to acquire a user, and then to work out whether that cost per click is worth it in the context of the millions of potential journeys that we could, or directions we could steer that user in. So that's where artificial intelligence is absolutely front and center, key to our business as a resource, because you couldn't hope to achieve the same result as we achieve in terms of the relevance of the delivery of a user to an advertiser. You couldn't hope to do that manually or on a spreadsheet or any other way you could hope to do it. It absolutely must be via a platform, a machine, and it's the machine's learning. It's the huge data set that underlies the machines, the platforms, that enables the platforms to make the best decisions economically. And the platforms continue to make the best decisions, and indeed they get better and better each year. The reason being, if you look on the right-hand side of the blue box, you'll see that the visitor sessions, so you can think of these as consumer journeys, these are 6.1 billion annually, and so it'll be more this year because the volumes keep growing, but at least 6 billion of consumers we acquire annually, and therefore you're adding 6 billion consumer journeys, whether successful or not, i.e. whether we successfully deliver those to an advertiser or they drop out, because we'll freely admit that naturally there is a dropout rate, and not all of those 6 billion clicks that we pay to acquire, not all 6 billion of them will result in a sale for us, but each one of those 6 billion objectively adds to the strength of the data set that we have. And when you've got 6 billion consumer journeys each year, you're then self-educating your platform to make even better decisions. The other important point I'll make related to AI and to data before we move on from this slide, which, as I said, I thought it was important to dwell here for a while so that you get a sense of the relevance of AI and data, and where some of these KPIs that drive our revenue, how they play into things. You'll see it says harnessing artificial intelligence and first-party data. But the other important point to make is that the data set that we have is our own data set. It's in-house, it's proprietary to us, and we own it. So many of you, probably most of you, will have seen in the press and will know about the use of third-party cookies. That's effectively third-party data, and that's where advertising models rely on knowledge of the browsing history of the traffic, the user, the consumer, in order to make the decisions where to steer them in their journey. We, as a company, have never relied on third-party cookies. We don't need to know, in terms of the users that we acquire, We don't need to know, we don't want to know what they bought last week, what they were looking at several hours ago. Those would interfere with the purity of the decision making that our platform facilitates. What we use instead, because we don't rely on that historic data, is obviously we know, because somebody's clicked on an advert that we have placed out there, we know what advert was clicked on. So we already obviously know a little bit about the user from the advert they've clicked on. We also know, because they've come to our platform, we can see their IP address, and therefore we can see quite legitimately, in a way that all internet advertising companies use, we can see the language that they're browsing in, we can see the browser they're on, we can see the time of day, their location. So all these naturally give clues as to what advertising journey we might steer this user towards. Plus, as well, we can see the device that they're browsing on. So the choice of adverts, or the range of choices that lead to an end advert that you might deliver to somebody who's browsing on a brand new top of the range iPhone or iPad, might be different to the advertising choices you might give to somebody who's browsing on a cheaper device. So we start to piece together a demographic picture from these clues. And again, it's our platform that does that. There's no manual intervention. You couldn't really operate this without it being completely automated and completely machine learning driven. As the user progresses through the questions and the options that our platform gives them, naturally we're also gathering more data along the way in terms of the answers, their preferences, and that's why we are very successful in matching up an interested user who becomes a consumer with the advert that is most closely in line with their intent as a consumer. And that's really where the platform is super effective at delivering additional revenue, and why the volumes keep increasing, because we satisfy the users by delivering them to something that's of interest, first of all in the way of content, and then ultimately in terms of a good or service that they may want to buy. And obviously as well, the advertisers are satisfied to work with us, because the high conversion rates of the traffic that we provide to those advertisers is very competitive with other similar sources of revenue at usually a lower price point. So if we could move on from this slide to the second slide, I will pick up the pace now, because as I said, the first slide, it was important to dwell on exactly the relevance of AI. But just to skip through the next couple of slides, this slide in particular, the largest of our individual business models that one would see is the middle platform here. That is referred to, the name we use for it is Tonic. It's the brand name we've used for many years. Tonic is not a household name. We don't need Tonic to be a household name. It's known within the digital marketing industry, but we're very happy that people don't talk about Tonic. It's not written about in the media, apart from in the investor media talking about us. But Tonic is the name of the platform that we use to acquire traffic from various sources of media and then deliver them to an advertiser. Complementary to Tonic, we also have two other larger, we have a number of smaller ones as well, but naturally we won't have time today to go into all of them, but we have two other larger platforms which take a consumer on a similar journey, but with a slightly different endpoint. So we'll move on from this slide in a minute, but on the left-hand side of the page, a very exciting platform that we've owned since March 2022 is the Vergleich.org product comparison platform that currently operates in German and French language, but will internationalize to other languages and territories. Now, the distinction between Vergleich and what Tonic does is that Vergleich acquires traffic from a media source, and it instead of delivering to an advertiser, it delivers to an e-commerce company. So we deliver the traffic direct to where they can actually buy a broad range of goods via Amazon or eBay or other large e-commerce companies. So it's a slight twist on the Tonic model, and it does mean that rather than our business model being solely focused on aggregators of advertisers. It does mean that we have the direct relationship with Amazon and eBay, and Otto.de is a large German e-commerce company. We actually have a what's called a paper action model, where we are paid a revenue share, a cut of the amount that our user that we deliver spends on that website. So when we deliver a user to ebay.de, to use the German example, we are paid a revenue share based on what that user spends on ebay.de. And it's a more satisfactory model in many ways for our customer, eBay or Amazon, because we're only paid when they're paid. That's why it's called pay per action. We're only paid when the user takes an action. Whereas under the pay-per-click tonic model in the middle of this screen, we get paid when our user clicks onto the advertiser's website, and therefore the advertiser might acquire 100 users from us, and we can't control or influence, or we have less control or influence whether they sign up to something. So under the pay-per-click model, which is super lucrative for us, and there is a huge future in it, but we have more skin in the game in the pay per action model. If we skip a few slides further forward, I just wanted to look at two more slides before I open things up for questions. So if we just go two further slides to the financials, which is slide 11, I think. 10, 11. Yeah, here we go. So financial highlights. As I said earlier, I'd be very happy if many of you will join other retail investor calls that we engage in. Team Internet's not a quiet company in terms of investor outreach, but just to give you an idea of the profit metrics of the group, you'll see that from revenue right the way through to operating profit, there is notable progress in respect of Team Internet's financial growth year on year. And if we skip another few slides further on, there's just one last slide I'd like to so we'll go a few more. I think we're heading for slide, next one. One more, that's it. So final slide, well, one before the outlook, the artificial intelligence slide 19. If you wouldn't mind going back one slide, please. That's it. That's absolutely perfect. So this slide is where we summarize what we as a business are doing in order to ensure that artificial intelligence remains not only something that is part of the company's DNA. So artificial intelligence is not something new for Team Internet. It's always underpinned what Team Internet has done as a business for many years. But there are several ways in which we're ensuring that remains to be the case, because we can't be complacent and claim that just because we've always used artificial intelligence, we somehow have a right to remain at the table as one of the preeminent companies in terms of use of AI as a resource. The raising the floor on the left-hand side of the screen, this is super important to us, because it's important that not only the data scientists and the engineers and the techie guys within the group, but everybody within our group, from right through to the finance team that work closely with me, and everybody else, all has at least a basic understanding as to how artificial intelligence works and can be used. And the most obvious classic example of that is we already use ChatGPT and other predictive artificial intelligence engines in order to generate content in terms of presentations and what have you. This presentation was written manually, but there's no reason why this slide couldn't have been generated by ChatGPT, for example. And it's important that we train people, including myself, to use these generative AI models effectively. So what's called prompt engineering, so being able to put in the right prompt to these devices in order to get the right answer out. It's not as intuitive, as far as I see anyway, as people might believe. So you can't, it's not like a search engine where you put in the terms and it will more than likely spit out what you want. You really have to be trained, in my opinion, to use these devices, because they start off intuitive, but to make the maximum use out of it, the training that all of our staff will get is absolutely critical. Last point I'll make before we open for questions, middle point of this screen here. Raising the ceiling is, of course, the principle of not just raising the floor by democratizing and ensuring that everybody within Team Internet has at least an entry-level understanding of artificial intelligence, but naturally we continue to invest in the artificial intelligence capability of our top data scientists and indeed all of our data scientists globally. I have read bits and bobs in the media recently about headlines like, "Is there an AI winter coming?" I.e., is there after the big hype about artificial intelligence over the last couple of years, will there be less investment in artificial intelligence when perhaps some of the media fanfare dies down? For Team Internet as a group, that's absolutely not the case. We must and will continue to reinvest in remaining at the forefront of use of artificial intelligence. So that means training our people and ensuring that we leave no stone unturned in terms of providing the resources to our people to remain at the absolute forefront. And that's everything I wanted to present in terms of Team Internet. So the last slide in the deck, the next one, is just an overview of our outlook, what we're going to deliver this year. And then the next slide will just say, thank you.
Let's go on the penultimate one, Sophie, because the word dividend caught my eye there. So are you confident that the bank, as per this slide, are you confident that the bank will approve dividend payouts?
Yes, the bank absolutely. The bank already was notified of the dividend we were paying. It's important that I stress that we're not our payment of dividends and indeed our commitment to buying back shares. We launched a material share buyback program last week. They are not contingent on tough rounds of bank approval. It's more that we need to notify the bank of the impact that any material use of funds, so whether it be an M&A activity or it be a dividend or a share buyback, we notify the bank and we send them the calculations. But naturally, as the bank sees that we are comfortably within our covenants, it is literally a formality. So the dividend was announced a couple of weeks ago, and then we launched a share buyback program last week. So we may not have too much time to talk about uses of capital, but for us as a group, when there aren't M&A opportunities to spend the operating cash that we generate each month on, our commitments are to return cash to shareholders by way of either dividends, which of course are semi-annual, or by way of buying back shares. That's why we were very comfortable last week, following a quarter of no M&A activity, to launch another share buyback program, which hopefully then returns some cash to shareholders.
Okay. Now, Dan reckons that Team Internet continues to trade at a significant discount to peers based on Edison's unchanged earnings estimates. Who are these peers, and do you agree with his assessment?
That's a really good question regarding the peers, because no single company has the assets that we have in-house. So both it's absolutely objectively true to say that no company has both an online marketing business and a domain name business, and that diversification within the same stock has been very useful to us over the last several years, and continues to be useful to us, because it means that while the media industry is somewhat cyclical, the domain name industry is less cyclical. So you have the continuity and solidity of the domain name business underpinning, even while the media business experiences some years of much more rapid growth than others. And then even within the online marketing segment itself, even there, no company, public or private, no company has the same combination of online marketing assets as us. So if you think back to the slide I showed earlier with the three platforms, Viglike, Tonic, Shines, Tonic platform has direct competitors. Wouldn't deny that there are companies that have the same similar licenses, similar business relationships to the ones we do. There are that there are a couple of publicly traded peers that one could look at if people want the comparison. So that I'm not avoiding the question, there's a company called System One Inc., which has a similar set of business partnerships to how our Tonic platform operates. System One Inc., not to be confused with System One, listed here in the UK. System One Inc. is listed in the US. It's based in California, and the company, as I say, has similar business relationships. It's somewhat more indebted than us, somewhat more highly levered, and that has an impact on their share price performance. And of course, I can't comment on other companies' performance, but just bear in mind that there is a distinction between the capital structure and the leverage of the two groups. Team Internet is much more modestly levered, and then other competitors of ours. There's a listed group on the Frankfurt Stock Exchange called IONOS, which has a subsidiary which is a competitor of ours, and then there are a range of other competitors. So there are other companies that one can look at, but nobody that's got quite the same asset base.
Okay, Billy, we are overrunning. Two more questions very quickly. Sophie, careful of that roaming cursor. Do you view yourselves as a takeover target for said peers?
Not for those peers, no. As a publicly traded company, we potentially could be a takeover target for larger groups, and I wouldn't say that that's a completely unrealistic scenario. I would have to stress though that our precise peers aren't of a size where we could be a target for them, but it's obviously not for me to predict if there are larger technology or media companies that might take an interest in us or our assets. It is something that actually, if there was interest and it was in the best interest of the shareholders, we are duty bound to respond to that. So that is not an impossibility. Naturally, we don't anticipate that as a business, and we're committed to continuing our growth as an AIM group, and very happy with what AIM offers us as a market. Okay.
Are Tonic, Vergleich and Shines the entirety of the ad tech bus?
Not quite. Tonic represents somewhere between 50 and 60% of our entire group, so getting on for 80% of our online marketing segment, and Vergleich and Shines are around 10% each. But there are a couple of other smaller platforms we have. Like, for example, we have a more like an advertising arbitrage marketplace platform, which I haven't spoken about today. All I wanted to do today, and what we generally do in the investor deck, is to highlight the platforms which are largest at the moment, but that should change each year, because, for example, the Vergleich platform, which currently is just under 10% of the business, that's been having a very good year this year, and I fully expect that we will spend more and more time talking about Vergleich, and indeed we will replace the term Vergleich with product comparison, because Vergleich is just our largest product comparison platform. We are replicating that platform in other languages, and therefore I look forward to spending more and more time talking about Vergleich, still talking about Tonic, and Shines is very new to us as a group. But as we integrate Shines, which is progressing very well, I think it's going. Our investor presentation is going to be even busier in future years, so we're going to need even more help from ChatGPT and others to just make sure that we distill it into the most succinct content possible. So that's a challenge to us from an IR perspective, but we look forward to it because it's nice to have things we love to talk about.
Okay, Billy, curb your enthusiasm. We've got loads more questions coming in, so I need one sentence answers, please. Do you disclose the profitability of these three ad tech businesses?
We haven't done to date because of the shared costs between those businesses, but as we receive feedback from the investor community that will be useful, we do evolve our disclosures each year. So I take the point on that.
Jonathan says most ad tech businesses in the US see flat to down demand and declining margins. What are your trends?
It depends by platform. In terms of the Tonic platform, it's fair to say that flat is what we're seeing right now. That's not our prediction for the future. Our prediction for the future is not flat. its growth. But vice versa, the Vergleich platform has shown very good growth this year, much better growth than we had forecast. So we're not seeing that as a rule comprehensively across all platforms, but yes, I would recognise that within the ad tech market, there are times are more difficult, more challenging now than they were, say, 2 years ago. But that is the seasonality of ad tech, and we're happy to be exposed to that.
Okay, in terms of seasonality, is your second half typically stronger? And will the US election support the online advertising market? And if so, how will Team Internet benefit? The final question.
Yes, second half is hugely more profitable for us, and specifically Q4 is by far our most profitable quarter. If you look back at the seasonal trends over the last several years, because of the strength of the advertising market in the fourth quarter, not just Christmas, but now that we have moving on from, or rather generated starting from Thanksgiving and Black Friday, it's now Cyber Week, a global phenomenon, not just a US phenomenon. So November is actually a bigger month for us than December, but Q4 as a whole, both in the advertiser and the consumer market, which Vergleich is exposed to, Q4 is massive. So as a listed group, that of course gives us challenges, because you don't know until, let's say, at least until November's delivered into December, you don't know exactly how much upside there is in the year. You know you're going to do better in Q4 than Q1, 2, 3, but you don't know the exact scale of the upside. Can sometimes lead to overperformance. But having said that, of course, we're looking forward to Q4, because Q4 is hugely more profitable for us, not only in terms of revenue, but also in terms of bottom line profit. We generate more cash in Q4. Just picking up on the other point about the US presidential election, one can't guarantee that a US presidential election will give the boost, the fillip to the global media industry that recent US presidential elections have done. We do hope for that, because outside the area of political spend, the fact that there's so much money on political spend means that all of the other advertisers are having to spend more for the same traffic, which is good for us, because they're literally paying more for the same quality of traffic. So theoretically, it should lead to an even bigger peak in Q4. But I should stress that that's obviously based on past performance of previous elections. Whether this election will also give us the same boost, we won't know the complete size of that upside until we see how Q4 goes. But it's certainly something to look forward to.
Many thanks. We'll leave it like that. Billy, that was a lovely way to end this webinar. Thank you very much today. Indeed. So thank you, Billy, Lorenzo, Dan, everyone for attending. My thanks to the team at Master Investor, particularly Sophie, my indispensable right-hand woman who I enjoy bickering with. The next Master Investor webinar is on Wednesday, October the 2nd. Again, 12:30 lunchtime webinar, when we will be presenting alternative investments and 4 inflation-beating collectible sectors. Our speaker for this will be from the Paul Fraser Collectibles Group, which is the world's largest privately owned rare collectibles dealer. You've all been stars. Many thanks. Thank you. Cheerio. Have a great day.